By now you've probably heard about a new tax provision, no tax on tips. No tax on tips is a new federal tax break for tax years 2025 through 2028 under current tax law. The rule is set up as a deduction, which means tips may still be reported as income, but eligible workers may be able to deduct a portion, reducing their federal income tax owed on those tips. For eligible workers, the maximum deduction for qualified tips is up to $25,000 per year. Be aware, there is an income phase-out beginning at $150,000 for single filers and $300,000 for married joint filers. To claim the deduction, your tips must be qualified and your job needs to be in an occupation where workers customarily receive tips. For more information about this, go to irs.gov/tipped occupations. There you will find an example list of qualifying occupations. To claim the deduction, complete Schedule 1A. Most tipped workers will still pay payroll taxes, such as Social Security and Medicare tax. And generally, no tax on tips affect federal income tax and not state taxes. You could be required to file IRS Form 4137 for Social Security and Medicare tax on unreported tip income. Good record keeping matters. Track tips you receive, keep payroll records, and make sure your tip reporting is accurate. To recap, it's a federal deduction, not an exemption. Tips must come from a qualified occupation. There is an income phase-out that applies. Payroll taxes, as well as additional Social Security and Medicare taxes, could be owed. Review Schedule 1A and Form 4137. Keep accurate records and report accurate numbers. Remember, this is general information and not tax advice. You should always consult with your tax professional.